Welcome out to Trading Justice 587. I think we got a lot to contribute to the dialogue out there in this podcast. We're going to talk about the rotation. It is the subject du jour as we head into the coming trading week. Obvious attempt at rotation. We're going to give you some historical parallels, some things to look for, talk about the catalysts that drove it. We're going to break that down, and having it happen in the middle of earnings, we're going to weave that in. This is going to be an important podcast, one I'm going to enjoy. You're going to hear me start getting giddy here in a minute because I love broad participation. I always do better in these environments. But before I get giddy and before I welcome out my brother, I want to highlight that we have a big event coming up. It is a Master Trader event. That is the name of the class. My brother Matt, who you are going to hear him wax eloquently about earnings in this podcast, is going to be teaching the 2 days of the event. And Matt, tell the people, tell the good people, tell the wonderful people about this coming event.
Yeah, I don't know if I'm going to wax too eloquently on the earnings side of the equation. We only got a few earnings out there, and they were kind of boring, to be perfectly honest. But boring is good for the kickstart of earnings. That's no doubt about that. But coming up 2 days from now, one day after you get this podcast, we are going to be teaching a new Master Trader course on Monday and Tuesday of the coming week. And we're doing this one, usually Master Traders, an event we do for our pro member community, but for our July 4th holiday sale season that we do every single year, we're doing this for our Trading Justice community, our YouTube community, and we are opening up for free 2 days of great training. You can come and learn the skills of the pros from a technical analysis perspective, as well as a trading options perspective. Going to have a lot of fun. Looking forward to the class on Monday and Tuesday, and certainly looking forward to the podcast today.
Register for that event. It's open to everyone. It's a great event. Matt, I'm in
the description if you are looking for the link.
Listen, I'm in a giddy mood. I had a great week trading. This has been a fantastic cash flow environment for the last little bit. It was a fantastic cash flow environment. And when I say cash flow environment, I'm talking about everything, right? Like it was a healthy, broad participation week. Always my favorite markets: gold, bonds. Energy didn't do much from a directional, but didn't do anything back from a cash flow. Cyclicals, agricultural chemicals, small caps, RSP, your average stock, industrials, tech. Everything from a cash flow standpoint was giddy, and there was a reason for that, right? There was a reason from that, and one that directional traders such as yourself are going to be taking keen note of. Matt, we had a catalyst on Thursday that set this off a little bit. It was the CPI report that led to some really healthy performances across the board, didn't it?
Yeah, it did, Mark. And you made a couple comments I want to mention here very quickly at the very beginning of the podcast. It was a great week for the marketplace. Only one sector showed some downward movement in price. That was communications, led by Meta. Meta had a 7% downward movement in price after some pretty strong performance there in recent history. But outside of that, I mean, you're talking about this week, real estate. Who had on their bingo cards real estate being the number one performing sector this week? I don't think anybody did, quite frankly. Utilities and real estate and healthcare, the three best performers.
Now, real estate caught me because I was kind of positioning myself for all right, CPI comes in cool type thing. And I missed real estate. I was like,
a lot of people did. It was a gap up. And
I'll miss it again because it's not a real sector.
Well, it is, as categorized by the S&P 500, but it doesn't track real estate the way you would think it would. But you're seeing good price performance across the board here out of almost every sector out there. And Mark, you made another comment that, I do better when the rest of the market is participating and not just a select handful. I think you literally just described 93% of the entire U.S. population.
Yeah, and man, I want to highlight on that because remember about a month ago, the fear gauge actually with market hitting all-time high went into fear. Mm-hmm. And this might have been 5 or 6 weeks ago, actually, but you had lots of things selling off, but tech rallying, creating the markets at all-time highs. And yet it went fear because of what you just said, right?
Yeah, it's quite frankly, over the last 3-4 months, outside of tech and communications, everything else has been flatlined. And so now you're seeing a catalyst event where you start to see, some relative outperformance in sectors that, we've kind of considered the forgotten indexes, the forgotten sectors over the last 3 months. The cyclical areas, the defensive areas, they really just have not been part of the conversation. And so when you see on a day where consumer cyclicals doing good, technology did good, materials did good, pretty much everything did good on Friday. And over the week, when you're looking at the cyclical and the defensive side of the equation, Mark, what you're really seeing is the improving condition on the divergence between RSP, the equal weighted S&P 500, versus what we do know in the weighted index of the S&P has been a really, a limited breadth conversation with AI, tech, semiconductors really kind of leading the charge and everything else being left behind. And so this was that week where this is the only storyline in the week, by the way. The RSP, IWM, left behind areas of the market. And the open question at this point, which is really, really important, is this just a 1 week thing? Or where you had algorithms go crazy and a little bit of giddy performance after a CPI report that came in and showed that the Fed is most likely going to cut in September. Is this just a hey, let's price in that in one singular moment in time, or are we seeing the early beginnings of a rotation story from AI, tech, semiconductors into the areas of the market that have not participated?
I mean, that is the question everyone is talking about this weekend as we head into the new week.
It's the only question that as of right now,
and it is an important question.
And so, right? And so absolutely, Mark. And when you're talking about you're doing better, everybody does better when the vast majority of the market is participating in some degree of bullishness out there. What's interesting, though, in this conversation so far, Mark, is that the improving condition on RSP, the improving condition on IWM, the small and the mid cap areas of the market, and we've seen some real good big volume price action in both those two spaces, has not come at the behest so far of the technology space, which is showing a little bit of shifting volatility, Mark, but I'm not going to call the end of a trend simply because.
No, and we're going to talk about this in a few minutes and we're going to analyze okay, let me be very, very open. What you just said about the question on everyone's mind, is this a temporary surge or is it setting up to take a leg or two higher in these areas? That's the question. We don't know yet, but we're going to have some really good tells that the market is going to give us starting this week, starting in the coming days, on whether it is or not. And we're going to walk through that.
Let's talk about that then, because, what would you need to see to have that confirmed? Because that was the only question that is important to me right now. Is we all see the relative outperformance, and it's impossible not to see the relative outperformance of cyclical areas this week. And so we all see that. We all know the storyline that's going on in terms of that upward movement in price. We'll break it down here in a second. But the ultimate question is, does that stick and lead into a rotation trend, or is this just
I'll tell you exactly what I need to see, and it's very clear. I need to see the same things I saw at the end of 2020. I need to see the same things I saw in 2021. I need to see the same things in these areas that I saw coming off the November lows of last year. I need to see the bulls demonstrate technical control on charts, right? 2 days gap up on the small caps is not control. It's a wild party in which you are drunk on the lawn because you had such a good time. But it doesn't tell you anything other than something is happening here, especially when it's confirmed by the volume, right? Especially when confirmed by the volume. What comes next? Is it orderly control on the charts from a technical perspective? You saw this in every successful rotation or outperformance.
It's just a 2-day party. It's a pretty big 2-day party participated by almost everybody in the market.
Yeah, I don't think it is. I don't think it is. You don't think it is. But getting that confirmation
The
here.
ultimate question for me is, what do you need to see next to increase your confidence in the rotation? And timing of this is a very important conversation, but I don't want to steal your thunder. Go ahead.
We'll lead into this. Listen, I'm ready to rock and roll. I got this crap all laid out in my.
Listen, again, the open question here is a very important one. Is this just a singular moment in time where we see rotation very quickly? And again, it's not abnormal in post-pandemic markets to see V-shaped recoveries in a very quick time frame, only to be given back in a shorter time frame. And so that's a really important question. Now, for me, Mark, I'll just start. Okay, for me, you can't deny the breakout of IWM this week. You broke out of the 210 area. That's a multiple time frame perspective. That is obviously a behavioral shift when over the last 6 months, you can't break out of an area and then you break out of that area. That's going to be a momentum shift. That's going to be a behavioral shift. That you cannot deny that from a technical.
And you talked about this in the newsletter for our pro members. You detailed this whole chronicle here.
So, number one, you have an official confirmed breakout. That's number one. Number two, when you look at the quality of a breakout, there's a lot of different things you look at, but one of the important things in the quality of a breakout is the volume side of the equation. And when you have an increase in volume going into a breakout, what that suggests is you have wide market participation. And a lot of times when you what the type of entities that it takes to create that level of volume is not you and I and the people listening to this podcast this week or watching this podcast this week. It's the institutions that are creating that.
Yeah, because Matt, I think it's very important to point out on this point, this isn't option contracts. This is legitimate shares of IWM.
Yeah, and Mark, not only is it legitimate shares of IWM, it's legitimate shares of IWM going into a very important earnings season where you now have people front running earnings results. And so it's a very important technical behavioral change in the marketplace when you break out of that 210 level on IWM on a massive increase on volume. But it wasn't just the Thursday relative outperformance on the
and Matt,
you
not
saw
to interrupt,
the same thing on Friday as well, Mark.
Not to interrupt, but when you look at two short-term shelf breakouts like that we had in February on IWM and the attempted breakout in late March, we didn't have any volume increase on either one of those.
No.
Like there, I mean, so you've attempted to break resistance levels, short-term shelves along the way, but there was no corresponding volume, let alone the dwarfing bars.
Let's be real, Mark. If those 2 days come on, scenarios where there isn't catalyst out there, we probably discounted a little bit. But when you're talking about those 2 days came on some really important.
Yeah, and this because I didn't know where you were going to go here because I was going to say coming up what I needed to see. November, when we saw successful rotation.
The reason I came here is because if we're talking about the volume and the participation, I think it's important to understand.
Oh, absolutely. Because when you look at successful rotation in the past, the famous example that we're going to compare to here in a little bit is November. Pfizer vaccine comes out. You saw rotation out of a lot of things that were doing well. Tech didn't end up selling off. We'll talk about that more in a second, but you saw real huge overperformance in other areas of the market. It was a catalyst. When you saw everything participate in the rally off the November lows last year, catalyst, Fed pivots. You need a catalyst to have these type of days, don't you, man? Like to break free from
catalyst to create that much synergy amongst different groups with different opinion.
I love that. You and I did talk about this before, but that is such an excellent point. It's like, how do you get agricultural chemicals and small cap banks and some industrial companies that make widgets? How do you create that synergy? Right?
The people that trade healthcare are not typically the people that trade.
Yeah. How do you create that synergy amongst all of them? You need a catalyst. I love that. I love that.
A catalyst. And that's what occurred on Thursday. On Thursday, the news of the week this week was the CPI report on Thursday. And we're not going to break it down in detail, but the important takeaway on the CPI report is it came in at 3% versus the 3.1 expectation. Now, Mark, we talked about the expectation, how it was already lowered coming into this week with the expectation of being 3.1% from last month's 3.3% on the year over year. And when you came in at 3%, that number was the lowest actual number we've seen literally in years when it comes to the year over year numbers. The month over month numbers came in at a negative for the first.
Yeah, and Matt, do you think
well,
basic human behavior, because once again, you don't have, like, everybody didn't meet Wednesday night around the world and said, hey, we're all going to do this. Maybe a few hedge funds.
There was not a joint bullish.
Were you invited to a Zoom call?
No, there was not a Zoom meeting on how are we going to interpret the CPI report as a bullish.
Do you think it is as simple as the negative number on the month over month number? The fact that it was a negative, the simplicity of the visual?
I don't think the market is as complicated as other people think oftentimes. Is the CPI report in the inflationary saga a much more nuanced and detailed conversation than the market had this week? Of course it is. Of course it is. Is inflation now on a trajectory of deflationary environment? No, that's absolutely ridiculous. Is inflation going to continue to be a problem for most people for the next 10 to 20 years? Yes, unfortunately. And I can ask redundant questions and rhetorical questions all day long. The simple reality is the market's not having that nuanced conversation.
No.
The market saw a negative number and they saw the year over year at 3%. And they just said, oh my goodness, that's the first time we've had a negative number in a very long time. How can anybody in the world say that's negative, right?
Yeah, and Matt, let's be like a lot.
It's not more complicated.
It's not more complicated. Oh, well said. You just described the market. And I think that's exactly what happened. And a lot of people, Matt, how many times have you talked about in recent weeks about the need for broad participation? How many people like myself had started to participate? I mean, you had a lot of market participants smelling this out, waiting for a moment. And I think you just described.
It was my base thesis, regardless of the scenario going through.
Which you laid out last week.
That was literally my argument last week.
That was your argument last week.
And looking at all these scenarios of how the market treats, regardless of the numbers that come in, the scenario was divergence improves. The only question I personally had was the path of that improvement on the divergence. Was it a skyrocketing RSP and IWM, or was it, tech coming down aggressively, whereas RSP and IWM continue to stabilize? That was the open question coming into earnings season that we discussed literally just last week. And it was just, quite frankly, amazing that the CPI report one day before the kickstart to earnings laid out the groundwork for them to start kind of aggressively going through that rotationary situation that improves the growth, the breadth conversation, obviously improves the divergent conversation as well. But so you got the CPI report on Thursday, and that was really the first catalyst that sparked that massive rotation on Thursday and Friday on that massive volume. Because what it did, Mark, is for example, it doesn't change my personal opinion on the inflationary side.
No, we will have a podcast in the coming months, maybe 2, maybe 5, on why inflation never died. Let's get that out of the way right now.
1,000%. That's coming too.
That podcast is coming
down the road a little bit.
We just got to tactically navigate this first.
And Mark, it doesn't change my opinion that the Fed actually has the soft silent target at 3% versus what they have a public target at 2%. None of that changes. Those are macro situations that take years to play out, quite frankly. But it does change something extremely important for the market participants regarding the path of policy. Because remember, how many times have I complained in the last 3-4 months regarding, listen,
Matt, your base case, and this influence, I'm going to give you some credit. You made me some money recently because you said for a long time now that this other thing, referred to the other 493 stocks. Yeah, be dramatic, 480.
It's 475, but yeah.
Yeah, but most and small caps and basically 98% of the investing universe in equities was not going to synchronize itself in an uptrend tick until the path of policy. You've said that. Now we've smelt that out.
Synchronized growth doesn't occur with uncertainty on policy.
And that has been a base case. Now the foundation has been laid, and continue what you were saying.
To be clear, I wouldn't cut in September, but I also wouldn't cut in December because I have a little bit more macro concern on the inflationary side of the equation. And that macro concern is a little bit stronger than my minor concern on the economic stagflation argument. And so, but that's not the point. It's not about you and what you would do, and it's not about me and what I would do.
We'll deal with that mess when it comes.
And what the listeners would do. It's about what the Fed is going to do. And the Fed has been begging for a CPI report that came in as a negative where they don't have to parse the data. They don't have to come out and be like, well, what about this? And what about this? All they can do is scoreboard and look at, hey, we got a negative print. And everybody in America is like, oh, we got a negative print. It's really as simple as that. And what you saw, Mark, on the CME Fed Fund, which is obviously a great way to look at the Fed Fund futures and kind of where the market expects the interest rate to go in the future. What you saw is a pretty big understanding by the market participants that the September contract for 2024, it does look like at this point that's where they have liftoff.
That wasn't 90.3% on Wednesday night.
1 week ago, it was less than 60%. Okay. So I know it says 72, but that's because it was the 5th last week, but it was in the 60s just a relatively short time ago. Mark, that is now at 90% for September. But Chucky, it's guaranteed to be 0.25 because you have 6% that actually think the rate cut cycle is going to happen in July, which means by September.
I also found it telling, will you go to the December?
A whopping 96% of the economists polled expect that rate cycle to now begin before September. That's never been we've never been that clarified on when this cutting cycle is going to happen. And not only that, it's not just the path of policy is not just when they start cutting, it's the path they take after they start cutting. Yeah. And it does look like at this point, it's 0.25, 0.25, 0.25, unless something unforeseen happens when we would get a 0.5 cut. We now start having an understanding of where they're going to go down to and the path they're going to take in terms of where they're going to go down into. You're not getting zero in this cutting cycle, but what you're going to get is the reduction of the restrictive territory, which is most likely a good 250 basis points off the top over the next 18 months or so.
Yeah, and will you give me December real quick? Those stubborn individuals that had been pricing in zero cuts, because this number had been, but they disappeared completely. The people that are only pricing in one cut, they basically disappeared this completely.
I still think there's scenarios where we don't get a cut till December, but those scenarios are quickly diminished.
Yeah,
like
they are.
The Fed right now, if you know about the Fed and if you can speak Fed, the Fed is laying the groundwork for a September starting point.
No, and my base case right now is they will announce that.
If they care about the election problem, which is how people will view that if they start in September, they could start in July, Mark, if they want to offset that.
My base case at a minimum is they announce in July a September cut, right? I don't think they have the consensus on the Fed speakers to get that super majority for a July cut. Because
that would be a historical change according to the dot plot.
Yeah, and so I don't think you're going to be able to round up the votes for a July cut, but I think they could get on board with the announcement. And if not official, pretty damn close to official, that they're going to cut in September to provide that market clarity. And so, Matt, you have a catalyst, right? The front running of the cutting cycle.
Second catalyst very quickly. Okay, so you got the cutting conversation. Mark, the follow through on Friday is maybe not equally important as the initial movement on Thursday following the CPI print, but the follow through on Friday is very important as well, as you had IWM, RSP continue to show that relative outperformance, continue to show increases in volume after you had the kickstart to the bank's earnings. And Mark, the amazing thing is, out of the banks, you had Citibank, you had Wells Fargo, you had JP Morgan. Those banks actually all went down despite the fact that they had beats.
I want to talk about that later.
New York Mellon Corp went up, gapped up, went up. But Mark, my point is, despite the sell-off on the banks that reported earnings, finance broke out, IWM broke out, things that are very financial sensitive, they actually bucked that trend because the earnings results were not bad.
Yeah. All right. I want to transition into what comes next. So I think we've done a pretty good job outlining why this move occurred, what was behind it, some of the initial strength. And I think we can conclude, and tell me if I'm wrong, speaking for you, they're going for it, referring to they collective market, participants, whoever you want to call they, going for an attempt at a rotation here, right?
Listen, yes, of course.
Okay, so
blind man could see this.
Yes, they're going for it, right? They're going for it. And so now it becomes a question in traders' minds, will they be successful, what to look for? Now, Matt, I saw a lot of, and I want to get into, and what we're going to do now here on the podcast is do some comparison to 2020. And this is something that I feel very, very strongly about. So I'll lead the conversation here.
Well, if you before you take over on that, can I just make one general point?
You can make as many points you want, bro.
Okay, because I love comparison analysis of history. You know that, everybody here.
We both do.
Absolutely love it. It's the best way to get an understanding of how a market will behave in different conditions. The one thing I think is extremely important for me, there's one thing above all things. And this to me does not change whether we're talking about the macro conversations of the rotation of IWM versus SPY, the improvement on the divergence. I don't care what the conversation is. When you break out on increasing volume, that's obviously good. But when you break out and you run into the breakout, it is extremely important to have trend confirmation.
Yes.
And what I mean by that is, and I talked about this in the newsletter, Mark, it's one of the topics I talked about when I was talking about the technical update in the newsletter this week, is confirmation is an important concept, but there's not one definition to the concept of confirmation. You could have candlestick confirmation, you can have pattern confirmation, and you can have trend confirmation. Any technical concept can attach a confirmation subject to it. And so when it comes to candlestick confirmation, for example, you want to see a candle close above the previous day's high. That is a pivot-based confirmation. When you see a pattern confirm, it's after a three days of consolidation, 4 days of consolidation would confirm a high base. When you see trend confirmation occurs not on the initial breakout. The initial breakout is what gets everybody excited, is what puts it on the radar for everybody, because it's one of those situations where everybody in the world is now talking about it. We're all aware of it. And it doesn't necessarily mean everybody's doing something about it yet. And so when you're looking at this initial breakout, and the volume's been amazing, but it was quick, Mark. It was 1-2 days, and all of a sudden you went up 10% in the marketplace. That got overextended fairly quickly. And so it's very important to see the confirmation of trends here. And the confirmation of a trend here is going to be extremely simple. You're looking for that next increase in support. Because when you look at the creation of a trend, the creation of a trend starts with a breakout. You got that breakout this week. You got it on increasing volume on a catalyst. We've already talked about all that. But the confirmation is not the close above the breakout channel. The confirmation is actually the increase in support against the now bullish uptrend. And so the thing about it is, Mark, is that if you miss that breakout, and a lot of people certainly did miss an IWM breakout this week, don't fret against that. Be patient, wait on the next pattern development, because the next pattern development is usually actually stronger than the initial surge of momentum.
Yeah, absolutely. And we're going to see some of those parallels. We're going to see some illustrations in examining 2020, 2021 of that. Now, Matt, the last great rotational market for me. Now, there have been periods where you've had overperformance of one area, underperformance, but true rotation was from November of 2020 to November, December of 2021, where we saw just classic rotation throughout the whole year. One area would take a turn, then another area would take a turn, and it was a fantastic price environment, created great trends. But that rotational environment, because if you remember the pandemic coming off the March lows, it was a little bit of, a lot of leaders, a lot of laggards environment coming off the pandemic lows, where you had tech in, certain, it was broader than just a Mag 7 tech thing. You had certain components, the pandemic winners, right? Remember that time period? Those things going up, while other cyclical and other areas got left behind. But there's, I saw a lot of people trying to throw crap at the wall over the last couple of days, as far as financial analysts, economists.
It's understandable. We don't have a lot of historical comparisons when IWM out.
Yeah, because you did have one of the biggest gaps in performance on IWM versus tech.
It might have been the biggest.
Yeah, by some measures it was. And so
there's only one or two data points to compare that level of outperformance. I think UBS came out with a note on Friday that suggested the Thursday price action was the largest divergence between IWM and the S&P 500 since 1979.
Yeah. And so when you have an event such as this is the big game. Trillions and trillions of dollars. People that are and so people are out there guessing, what does this mean, right? And I feel very confident. This is why those that listen to this Trading Just podcast love this and keep listening. I'm going to give you what I think it exactly means. And I think it's better than most analysis. And I think what's happening, Matt, is they're running, and when I say they, collective market participants, price action algos, whatever you will, the November 9th, 2020 playbook. And they're starting right off the bat. What makes this so interesting?
By the way, November, you're talking about the vaccine.
So the Pfizer vaccine is announced. So we had an environment where we're coming off of, where you had some really big winners, right, coming off the pandemic lows, some real things, and you had a large section of the market, ironically not as large as the one you have now, not participate as much during that stretch. They didn't go down.
Similar conversation though, Mark. I mean, when you're talking about the uncertainty of the economy at that point, there was a lot of concern regarding the majority of stocks in the market and what the economy was going to do. You didn't really have concern on the large moats. That's kind of when large moats became such a safe haven. But this was a very important conversation when the vaccine came out. It gave the market confidence that a lot of these companies were going to be able to reopen.
That the path of COVID policy was going to be a little clearer, right? Because, people, remember how much fear there was in these companies are going to go bankrupt. These companies, a lot of uncertainty.
Yeah.
All right. Well, why I think that this is the playbook being attempted at right now is because of the price action that you saw. Because what you saw on November 9th was that you saw a large gap. Now, there were differences in that you didn't hold the gap on November 9th. But what you saw was a huge, massive difference in end-of-day performance between the winners, right? Those stocks that had win, and we're going to loosely define that in tech since they were a bigger overperformance. We could go look at the Zooms and the PayPal. We could go look at all the winners, and we're going to see similar price action. But you are going to see huge difference in how on November 9th, 2020, everything else did versus tech itself, versus pandemic winners themselves. Where on November 9th, you gapped up in a lot of different areas, far more in other things. In a few minutes, we'll look at finance and XLE. But at the end of the day total, NASDAQ was down pretty healthy, several percent, big bearish engulfing candle, whereas everything else had outperformed quite dramatically. And so your gap, and this was the closest gap, like just raw percentage totals, the difference in who won, who low, that I could find between what happened on Thursday, where you had tech sell off, everything else do well, define it just by small caps, huge percentage gap in performance. You had a very similar percentage gap in performance on November 9th, 2020, right? So starting with that initial day, and then we'll build the case here in the coming minutes on other points. But what do you think about this particular points on the day of catalyst price action?
On the day of catalyst price action on IWM, we're talking about the November 9th of 2020 price action. It very similar after the cash open. They very similar price action, both shallow wick on top, finished towards the low of the day, shallow wick on top. We're looking at the Qs, finished towards the low of the day. So very similar post cash open price action. The difference was the percentage on the gap up was historic on IWM, and you had a shallow gap up, a little bit more of a common gap up on the Qs. And so the relative outperformance was on that overnight action when the actual announcement was made on the vaccine. When you're looking at today's price action, Mark, in comparison on the Qs versus what we saw on IWM this week, you saw a very similar situation on IWM, massive overperformance on the gap up. But Mark, the difference was even bigger in my estimation than the divergence we saw in 2020, because if you recall, the overnight action was identical on IWM versus the Qs in the 2020 case study. The difference is after the cash open occurred, in 2020 on November 9th, they both performed very, very similar. The difference in 2024, just this week after the CPI report, they both got IWM gapped up. The Qs did not gap at all. And IWM finished towards the top. The Qs finished towards the lows of the day. And so I would say it's a very similar time frame. It's an appropriate case study to call out, but I would say the argument for IWM this time would be even a little bit stronger than the argument for IWM last time.
And when you switch the IWM chart to either XLE or XLF, I don't care which one, because we saw, and let's highlight that November 9th, time period.
You just talk.
So on November 9th, and so we saw on that initial catalyst, we saw similar price behavior in significant gap up, held the bid a little bit better in both XLE and XLF. Huge, massive gap, held the bid on oil. You actually closed closer to the highs than not. Held most of the bid that day, most of the gap up on XLF, huge, massive difference in gap, huge different, right? And so you kind of see the parallels to things that were not performing. Finance had not participated off the March lows, right? Off the very low, sure, everything.
Energy
right?
was under the 200-day moving average. Finance was at the 200-day moving average. The market was above the 200-day moving average. It's as simple as that.
It is as simple as that. And then you see this gap up, this attempt at a rotation going for it. Mm-hmm. And so there's a lot of parallels on the price action that occurred on Thursday when you look at the price action that occurred on November 9th, 2020. You with me on this one?
Yeah, I'm with you so far. Yeah.
All right. So now what happened next in 2020? Because we're only one day into the post reaction in this attempt at rotation now, right? And so since we're here, let's just, you can go keep the XLF chart here.
You shouldn't be looking at the charts.
Okay, I'll stop looking at charts.
Majority of people are listening to you, not
all right. Fair enough. I am the typical can't multitask, can't walk.
I am just pulling up charts as you talk to illustrate your point.
All right. So what happens next? And this is for me when analyzing this time period on what to look for in what comes next. When I look at these charts, you see everything that you want to see in a post gap up situation. We deal with this all the time. Now, in earnings, we deal with this scenario all the time in earnings. We just don't deal with this scenario every day when it comes to major areas of the market where we're dealing with massive gas up. And what does this mean? What do we look for? We deal with this all the time on earnings, right? Something gaps up big. You don't trade that day, right? You don't trade the next day. You typically wait for development on the market to give you a sign on what this means. Now, it can come in very different forms. You can have orderly pullbacks. Now, what happened in 2020 is that you stuck the gap landing, so to speak. You gapped up and you started to consolidate, forming some version of really weird or classic high base patterns.
I would just label them general consolidation.
But you basically stick the gap up. Now, I love control on a chart because for me, it tells me bulls are in charge. Now, that's not universally 100% always true, but it's in this situation with a gap up. Whenever you see a company gap up on earnings and it sticks the gap up, doesn't that feel bullish every time?
Well, it's the defensive nature of the market. You will see that as a defensive posture. The market is defending the price action, and so yeah, and it's an excellent point to call out on earnings because we're going through earnings season, Mark, and in earnings season you're going to analyze the gap, and you're going to analyze the gap from a traditional gap perspective. Is it a runaway gap? Is it an exhaustion gap, breakaway gap? Is it a catastrophic gap? Different gaps have different probabilities of the immediate next movement there. We don't analyze the gaps in the market like that in general because it's very difficult to create the synergy to have a 2,000 stock area of the market like IWM gap. It's very, very difficult to get 500 stocks in the S&P 500 to simultaneously do the same thing and gap. So we don't see those gaps very often. That's why there's not a lot of case study. But you're absolutely right. Whether it's the market, whether it's a commodity, the human behavior that is basically the why behind the price action, that doesn't change whether you're talking about 2,000 stocks or one stock. And so when you see a gap up like we did in November of 2020, and you see the market play defense the way it did, you're going to see that as a positive. You're going to see that as a positive from a pattern perspective. You're going to see that as the market playing defense, and you're basically going to see that as, all right, let's consolidate and wait on the 90 MA to catch up. And once that does, let's get ready to giddy up and go time. And so that's kind of exactly what happened in 2020 after the gap up. And again, I want to be very clear. Not only did you have a technical, very consistent environment in 2020 with the gapping situation, Mark, you had a very similar economic conversation at that point. We were in the early stages of the recovery. There was a debate on the vaccine, when it was going to be launched, and the concern was whether or not these smaller companies could continue to withstand an economic barrage coming at them nonstop in 2020. It was a horrific year from an economic and just in general, 2020 was a horrific year. But in IWM, in that horrific year, once that vaccine came out, people saw that path to these companies and all these workers coming back to work and kind of seeing a path to a normal society to a certain extent. Well, the market gapped up on that news, stuck the landing on that news, and then it had a wonderful, wonderful trending environment for a very long time.
The next year,
And so, yeah, there was a lot of similarities. I mean, obviously, we're not talking vaccine this time, but we are talking in the last 2 months, Mark, a lot of concern regarding the slowdown of the economy and whether or not the Fed was going to overshoot on the policy side of the equation and create a very difficult economic landscape for the great majority of companies in the market, and that's relative to IWM. And so, yes, now you're seeing a little bit of the same, obviously different from an economic perspective, vaccines versus talking about a policy conversation and an inflationary report, but very similar in terms of the gap out. This time, I would say it's actually stronger. I actually think you have more pent up demand on IWM this time than you had last time, quite frankly. And so you have a massive spike up in volume. You obviously move up against the price action. Mark, if you're looking at this from a pure technical perspective and you're assessing IWM from a pure technical perspective, you would call this either a breakaway or a runaway gap. When you gap away from the price action, that's got to be a breakaway or runaway gap, especially when the area of the market you're looking at runs away from where you gap to. And so you got to be looking at that as a bullish condition from a gapping perspective. And so the only thing missing here on IWM versus, the case study you're pulling is you had a really good secondary pattern that justified the initial movement. And I think that's the only thing we're really kind of waiting on.
That's what we're looking for.
Is that secondary pattern similar to what we got in 2020? Because you don't want to chase an overextended breakout. Mark, even in that vaccine announcement in 2020, the market gapped up, but then it stood there for a good week to 2 weeks, depending on the space you were looking at. I never feel the need to chase price action because technical analysis will always come back to some degree of reality. And so in my estimation, it's a very significant gap. It's a great case study in the comparison against 2020. And in that comparison, the only thing that the final conclusion of that was that secondary pattern and seeing the defensive nature of the market support the gap. You want to see the same thing here.
Yeah, no, and so I love at this point where it's like, all right, if you all came crashing down in the next few days, no harm, no foul. But if you see, and we have a lot of charts that could produce trades now, right? Like things coming off the bottom, things in the middle, things up top. You're going to have a wide selection.
If IWM sticks, you're going to have more selections than you'll know what to do.
Then you know what to do with. It's going to be a thing, and you can watch the development in the coming days, in the coming weeks, and trust your eyes. Right? Well, trust your eyes.
And Mark, I love the timing of this conversation. Others might not. Others might, oh man, we're having this conversation at the very beginning of earnings.
I can't do anything with that breakaway gap anyways.
People are missing the point. In the first 2 weeks of earnings season, we're sitting on our hands a lot trying to figure out the themes in the first place. And in that same time frame, we get a breakdown and analyze an IWM technical situation that could fit the same time frame as when we start figuring out this earnings conversation. And so I think it's primed. I do. I think the secondary pattern, if the secondary pattern gets nailed here, it's probably most likely going to come from an earnings story. And there is a lot of influence on RSP, IWM. There's more influence on earnings on IWM and RSP.
And at a minute, I feel very confident about what I'm going to say. At a minimum, you will see broader participation moving forward at a minimum. Now, is it the universal, the whole market to trust? I don't know. I'm going to let the charts tell me that. But I feel more confident today hitting non-preferred areas on trades than I have in a long time. I get a good setup.
Question. We both believe that we're seeing some rotation in the early.
The attempts there, 100% attempts there.
We both believe that secondary confirmation is very important, and that will be the next trigger point on this saga. We both believe that the timing is very important as we navigate the next week and a half of earnings and this secondary pattern in IWM. I agree with all of that 100%. The difference here is I think you're more on this. if IWM successfully goes through a secondary pattern here, I think you're more on the it's going to happen because tech comps comes down a little bit.
Not necessarily. In fact,
more on I think they stabilize.
No. Now, I want to give you one last point actually on this, and I want to look at the Qs or NASDAQ futures, whatever you want. They're going to tell you the same story on what tech did, because all right, so you have something rotated into. We're looking at a successful rotation, and where you had an area of the market take off.
Yeah.
What is really going to make me bullish tactically for the coming months, probably the rest of the year, and we might have pullbacks and this and that. Well, you're traders, you analyze it along the way. If I see tech stabilize and do nothing, because in 2020, in a successful rotation,
it stabilized and actually started going back up pretty quick.
Yeah, and then in the start of the year, it took some time off, and that
synchronized the growth in the sectors, bro.
But those things that have been tech and didn't do much, in fact, was very orderly in the 2 weeks as you were pumping finance, you pump tech just orderly, and then started to glide up.
Party at the 9 EMA pool party. That's all it was.
And so if I see, and I think it's particularly important for me at least to see that in tech, because we have some real narrow participation this time, right? Some real narrow participation. And can I see the orderly move into other things while tech maybe stabilizes here? If I do that, like every day that I see that, the more bullish I'll get.
See, and for me, I see tech as slightly overextended right now, technically. So I would expect a little bit of stabilization at the top. I would expect a little bit of pattern development at the top. Mark, the reality here is this. About 6 weeks ago, I wrote a newsletter detailing the divergence of this entire conversation, right? And laid out.
This is why you are a pro member at Tackle Trading, by the way. We are ahead of the market.
And laid out the historical understanding of the divergence here. And I also laid out what typically transpires as they get realigned. And Mark, it is in these moments where you can get realignment here. And that's what occurred in November of 2020 is you got realignment in an all.
And look at the result over the next year.
It was an all everything market. It
just took its turn.
Was one of the best markets we've seen in a very, very long time.
2021 was my best trading year ever.
And we had realignment in November of last year as well, Mark. And what did we have? An all everything market from November to February, a 3.5, 4 month stretch where everything was really, really, really good. Is this different? Of course there's differences. But we are seeing those similarities play out that we saw in November of 23, that we saw in November of 2020. We are starting to see those similarities play out because as of right now, Mark, you now have the Qs and IWM, both short-term overextended, with both of them expecting secondary patterns. When was the last time you were able to say IWM and the NASDAQ were both simultaneously overextended with the expectation of secondary patterns? Obviously, a little bit different path to getting overextended.
It actually did not occur in the November rally. IWM was very orderly in its stages up.
Yeah.
I'm trying to think.
And so my point is,
I don't know.
Improvement in IWM does not necessarily have to happen at the behest of the leadership of the marketplace. Remember, that is what we have seen in recent history, but there are pockets of time where you do get some consistency in aggressive, cyclical, and defensive. Is this one of those times? Mark, I'll remind you, there's $5 trillion on the sidelines here. They don't need to take profit from NVIDIA to go buy Caterpillar. They don't need to do that. You can have money flow come in from other sources here. So I'm not ready to call tech dead, but I would say tech is slightly overextended going into earnings season, which will put that, which will honestly, not the worst scenario. Because again, how long does it take overextended situations to get alleviated? Usually not a couple days, usually a couple weeks. In that couple weeks, what are we going to see? We're going to see Taiwan Semiconductor, Netflix, Tesla, and a whole host of other earnings coming out of the growth areas, which means we'll have an understanding of where the Nasdaq wants to go a little bit more. In that same time frame as IWM is overextended and we're in need of secondary patterns, what are we going to see? A whole host of healthcare and financial companies reporting earnings that's going to give us a much better understanding on whether or not this initial movement wants to have secondary movements in it as well. So you're overextended, yes, but you're going through a time frame where you're tapping on the brakes because it's earnings season in the first place. And I just think the next couple of weeks could see some real good patterns develop in the time frame that would alleviate the overextended conversations. And then we would have a heck of a lot better understanding of who's going to lead over the next few months, right? Who's going to lead over the next few months? Is it going to be the cyclical areas? Is it going to be the all everything catch up story, or is it going to be the reemergence of momentum in AI? Regardless of the scenario, I think the market is primed to give us answers to those questions over the next week to 2 weeks. I think it's a good looking market right now. I just think we need to see secondary patterns to confirm the initial momentum in IWM.
I love the setup here. I think we've done a good job illustrating the case, the reasons, the parallels, what to look for. Now, if we just don't have earnings season blow it all up, Matt, but that's why I have an earnings expert to help break things down for me.
Listen,
I love the breakout on the Dow.
The Dow Jones breakout is legit.
You have to play it.
A lot of time talking about IWM, but the Dow Jones breakout is absolutely
that is playable on Monday for me.
This is a beautiful breakout, and yes, you're absolutely right. Just don't mess it up. Earnings. But
no, and so let's close out. I want to close out the podcast firing through earnings results and then going through our global market sections firing, because there's interesting things happening there too.
Okay, where do you want to go?
What happened on Friday? Break it down. What was the blended growth numbers? What were the earnings?
Blended growth becomes
because I'm going to ask you every week on this podcast when we start earnings.
Ask me a few things. So where do you want me to start?
Well, the first thing I want to know at the start is where are we on compared to expectations? Because you last week laid out high expectations. This is going to be important. That is the first thing I want out of your mouth on earnings every week. And then you can go as an earning expert wherever you want.
Where are we at against expectations? Expectations, we have a high bar coming into earnings season. That's not going to change what I need to see as we navigate earnings season. The first thing the first number I kind of look at every single week is the blended growth number for EPS. At the end of last quarter, June 30th, the blended growth number was 8.9%. Okay. And that was the expectation for the second quarter reporting season was 8.9%. So at the end of the quarter, we were expecting these companies to report 8.9%. Now it's been 2 weeks since the end of the quarter. And so since that time frame, blended growth has went up to 9.3%. Now, if you'll recall,
so far so good.
So, and that's what you want to see. If you recall, last time we were having this conversation, Mark, between the end of the quarter, March 31st, last time we went through earnings season, to the first couple of weeks, we actually saw blended growth go from 3.5% expectation for the first quarter down to a 0.5% after the first week of earnings season. And that was on the backs of the financial reports, which were okay, but you had two massive revisions to the downside in the healthcare space that brought the blended growth down. And Mark, it was a battle to fight back up all quarter long last time. And then if you'll recall, in the last 3 months, in that fight back up on blended growth, you basically had cyclical do nothing for 3 consecutive months because it was a battle. That did not occur this time. You didn't have these big revisions in the cyclical to the downside. You actually had an elevated expectation coming in. And then after the first week of earnings season, you went from 8.9% up to about 9.3%. And so you're not looking in the first week of the banks, you're not looking for a theme to develop because of what the bank said. That's not how it works. What you're looking for is just things not to go terrible. And that's, with that said, the banks were not terrible on Friday. They were perfectly fine. Delta was perfectly fine on Thursday. I thought they had a good report. So a lot of companies actually went down this week on the report. Delta went down, JP Morgan went down. I would say both Delta and JP Morgan had good reports. Remember, expectations on individual companies are a little bit elevated. And so despite some beats out there, the beats are not as much as what we historically see. So to me, Mark, that makes perfect sense. If the bar is set a little bit higher and these companies are producing the same results as they were last quarter so far, well, you're not going to have a big veracity of beat right now. And so as of right now, the veracity is coming in underneath the 5 and the 10-year average, but the blended growth is improving. EPS beats, and we only got about 25 companies that have reported earnings so far, but EPS beats are right around 81%. That's, nothing that's going to, move the needle at all as of this early in earnings season. 77 is the average. 77% beats is the average. I fully expect that to come into 75, 76% by the end of earnings season. Revenue is only coming in at 56% that are exceeding the revenue forecast right now. That's underneath the 5 and the 10-year average as well. Revenue is going to be a little bit of an issue this quarter, in my estimation. Right now, it's early in earnings season. And in my estimation, we're still in week one. Remember, the first week of earnings season, it's just the banks and Delta and Pepsi, and that's Thursday, Friday. So we're still in that first week, but so far so good. Most companies have went down on their actual earnings report, but the market's going up on the earnings saga and obviously the pivots on the CPI report. And so you just don't want to see things go bad in the first week. And as of that, the banks passed the test.
That is wonderful to hear. Let's get over to gold real quick, Matt, because we got a catalyst.
Very quickly. Okay. When you are talking about earnings, though, Mark, this week.
Oh yeah, thank you. I my bad.
This week is very important, and each week will become more.
Yeah, this is how I view it, Matt. Like, because every week we have a tech storyline, right? This week it is Taiwan Semiconductor, right? And then of course Netflix, as far as sentiment as much as anything. But there's no avoiding. There's no avoiding the next 3 weeks, right? Like I can't navigate around any one thing. But this is going to give you, this week is perhaps the most interesting for me out of all the weeks that come, because this is
till Apple week.
Listen, but that's a story. This is going to give me the first test of a cross section of large cap companies in different sectors amidst the rotation.
It's going to test the rotation theories this week
because you have in every sector.
You have a tremendous amount of companies in IWM. Those aren't listed here, and there's a lot of them. But a couple companies to keep your eye on that are very important this week. And I'll give you 1 or 2 per day. On Monday, it's Goldman Sachs, it's Goldman Sachs, it's Goldman Sachs. And it's
all right, and I'm going to play this game, and I'm going to say what's the most important report that day for me.
Okay, Goldman Sachs on Monday, and
it's Goldman Sachs.
And this environment is set up for Goldman to be a rock star over the next 6 months. So let's see what they produce on Monday. On Tuesday, I would say the most important on Tuesday is United Health.
I agree 100%.
That's the first healthcare. Don't get me wrong, Morgan Stanley, Charles Schwab, Bank of America are important. But
what index is it also a part of?
I've already seen their reports. They reported on Friday. I know it doesn't sound that way, but when the banks report, it's very difficult for one bank to be so radically different than another bank in a very similar environment. United Health's the first healthcare company to report. And so healthcare is going to be a very important cyclical part of the conversation. I assume you agree with United.
Well, and plus, United Health being a Dow stock, where a Dow is breaking up, and part of that things that have not participated lately. I just think that's a big one on Tuesday.
Wednesday, to go on with the healthcare Dow conversation, you got Johnson and Johnson on Wednesday. I would say that is an extremely important one. But Mark, ASML is a infrastructure AI play. It's very similar to Tackle 25 Applied Materials, where they produce a lot of manufacturing for the semiconductor components. NVIDIA, for example, buys ASML products. And so it's a little bit of an early sign on the AI side of the equation. And so
ASML is, for me, the most important, but not the raw numbers, the market reaction.
The market reaction to ASML. If they sell regardless of the
numbers. They sell good numbers.
If they sell good numbers, that will tell you there's a general theme happening out there. But Mark, you don't have to wait too long, because in my estimation, the most important report of the week this week is Taiwan Semiconductor on Thursday. They are a linchpin in the AI saga. They are the gasoline that feeds NVIDIA, that feeds Apple, that feeds so many different companies from an AI perspective. Taiwan Semiconductor on Thursday. Thursday also has Netflix. That's going to be an important one. Netflix, not last quarter, not the quarter before, but 2 out of the last 8 quarters, Netflix has been a catalyst stock. So I'm certainly going to be looking at them. Mark, off the beaten path, Intuitive Surgical on Thursday is going to be important. They're another AI name in the healthcare space. They focus on robots in the healthcare space. That's a really, really important one. You got other ones out there like
I'm going to get DR Horton. And once again, it's not numbers that interest me. It's market reaction. If you gap up on any numbers, right, this is one of those specific lowering of interest rate path of policy impacting housing. How bad do they want to pump it? Like they pumped it hard on Thursday. They pumped it hard on Friday, type situation.
And then on Fridays, quietly, but I think one of the more important ones for us at Tackle Trading is Schlumberger on Friday,
I agree,
which is a catalyst stock in the energy space. And with the energy doing what it is in terms of the short-term neutrality, reversal type situation, we're going to get an early sign on whether or not there's an appetite and a desire for energy at the low point, with Schlumberger being a little bit of a catalyst stock. So we turn it up a notch here in earnings season this week. And
it's going to be a fun week.
Yeah, and obviously, we recently made a decision to merge our halftime report, which has been traditionally produced on YouTube, into the Traders Lounge in the pro membership of Tackle Trading. But regardless of where we do the halftime report, we're going to be breaking down these numbers every single day in the Traders Lounge. And so if you love the earnings analysis we traditionally do in the halftime report every day during earnings season, come join us at Tackle Trading, become a pro member, and join us in the Traders Lounge every day, because we're going to be doing that same type of analysis every single day in the Traders Lounge. The difference is I'm going to be able to identify the technical edge a little bit more cleanly there versus on YouTube. And quite frankly, we love the participation with our community as we're breaking down information in the stock market. And that's a little bit more difficult on YouTube, given the fact that there is a lag in between when people are asking questions versus when you can participate. And so we're way excited, guys, for the new Traders Lounge at Tackle Trading in the pro membership. And we're going to be breaking down these numbers in the Traders Lounge every single day. So I would say, in my estimation, the most important earnings announcement this week is on Taiwan Semiconductor. The most important, but the most interesting ones would go to confirmation on the rotation theory.
Yeah, I think there's just so many stories. This is like I don't know. I'm
Health Johnson.
I'm just geeked up. I'm jazzed up.
It's an important week.
Making money, happy about that, and want to make more money, because it's never about whether you've made money or not. It's you always want more, right? You want to put your knowledge and maximize that. Listen, there's a million other things I could talk about, but
stuff. What about the next time?
Yeah, there's a million other things I want to talk about, but I want to wrap up the podcast. But I cannot without talking dollar gold, because one of the reasons I'm in a good mood is I made some money on gold. Now I want to maybe look to make new positions or whatever, right? And you're always looking at what is a trigger that could send gold up for the next leg, right? A dollar breakdown could do that, Matt, as we battle 3-month consolidation on gold. I think breakout analysis is in play, especially when you look at this dollar chart. Matt, you've been chronicling this lately. Break down what I'm babbling about here.
You're babbling about a very important pattern we're seeing on the dollar versus gold right now. It's something I discussed in the halftime report pretty much all week long this week, regarding the bear flag against the dollar, the bull flag against gold. I remember one day this week you were talking about gold coming down when it pretty heavily when it got blasted on that 2400, and I'm like, what are you talking about? We caught the 9 here. Don't get too caught up over a big up day and a big down day. We caught the 9 earlier this week, and once we caught the 9 earlier this week, that was kind of in the same time frame that we kind of consolidated a little bit of a bear flag against the dollar analysis. And so I saw a really good edge, and I even said in the halftime report, this is tradable above 2400, quite frankly. And it was a good little breakout of 2400 on gold. And now you're talking about a real important conversation, because if you do violate on dollar, and I would expect a little bit of a low base before the dollar breakdown, but the dollar breakdown is the most likely scenario right now. I think there is an edge against the dollar breaking that 104, and it's not a guarantee. Resistance is really, really tough to break. Support is really, really tough to break. The last time we tested against this 104 level, which is really important on the dollar index, it was tested with heat. The same degree of heat that you're getting tested. And what happened? It held against 104 and a massive upward movement in price and a nice little bullish uptrend that gave us all a little bit of heartburn in gold and the market in general. And so 104 could hold. There's no doubt about that. But if it doesn't hold, you're looking at a scenario where you're starting to see momentum on gold, and you're starting to press up into this upper end of resistance right around that 2450 position on gold. And so when you are looking at gold, you can definitely see some developing patterns around 2450. You can definitely see that occur over the next week and a half, 2 weeks. And in that same time frame, gold stocks, they are just lifting.
That's great. I mean, it was a great week for gold stocks.
They were just lifting off right now. Not only is gold going up and the dollar going down, you're also starting to embrace a cyclical conversation, which obviously gold stocks have a lot to do with. And so gold stocks lifting off, they look really, really, really good right now. Going into this week, gold stocks are overextended. I would wait on secondary patterns.
I added a gold play with a covered call early in the week, and it's already getting blown up, keeping up with theta along the way. These are good problems to have. No one's going to complain. Nobody is going to feel bad. But Matt, this is like just an example of there's a lot of potential pattern develop that could occur on a lot of different charts. There's going to be a lot of dealer's choice coming up. If this rotation sticks on any degree, which I do believe it will, I just need to see a little confirmation here,
the only
right?
question I have is what's the pattern, right? Are we talking consolidation high base?
And do you have that big red candle day on small caps that then gets gobbled up immediately type? That's just pattern development, right?
Whatever pattern. I mean, that's the open question. Are we talking pullback or are we talking high base? And so obviously that's going to be very, very interesting. That's an open question. But outside of that, and then the next question would be, what is the average duration of the catch up on IWM versus the rest of the market when you do see these types of environments? And typically speaking, in 2023, when we saw the improvements of the divergence conversation, the market caught up for about a month and a half. That kind of fits the narrative that UBS put out there, that on average, the catch-up saga in IWM, when you see relative outperformance on IWM versus Qs, as we discussed for the most of the podcast, on average, there's about 28 days of relative catch-up. When you look at the November time period last year on the catch-up saga, once that started taking hold, it was probably about a month and a half until the markets realigned and started trading in a little bit of a similar capacity. And so if that average time frame, and again, I want to take that as the Lord's word here, Mark, given the fact that there's only a handful of case studies in history that we have seen these similar environments, but it does look like the catch-up saga would be, secondary pattern gets confirmed, And then the next leg is the catch-up saga. And that's why this is so important, because these catch-up opportunities in the cyclical areas, in the defensive areas, in the rest of the market, they don't last long, bro. Like historically. Well, and that makes sense given the fact that tech usually leads historically.
Yeah, no, it's listen, it's an opportunity, right? And this is what you do as trade. These are my final thoughts, and then you can send us out, Matt. It's just like, as a trader, you're worried about the next time period, right? The next 3 weeks, 4 weeks, 5 weeks, 6 weeks, right? Like you try to, for me, it's not just a day or two. It's like, what's the next little time period? Take it, and then you reevaluate, right? 6 weeks from now, I might be a raging bear, right? But I'm looking from bullish tactical opportunities. I think there's a case, right? It's just watching patterns. And I'm very excited to have diverse technical opportunities in front of me potentially. Send us out, Matt.
Yeah, Mark, fantastic conversation. Really enjoyed your listening to your thoughts on the very important topic, whether or not we will see that catch-up story that was initially fired off this week. But Mark, the one thing, and don't get me wrong, you and I can geek out on short-term technical conversations, short-term market themes, short-term economic conversations. We can geek out on these types of topics, no doubt about that. But Mark, the simple reality is to make all of this work, education before application. And if these environments do confuse you and you need a little bit of understanding on how all of this works, well, I got some good news there, Chucky. I am teaching a class, not a webinar, not a little video. I am teaching a class on how to trade the markets. Day 1 starts on Monday. Day 2's on Tuesday, both at 6 p.m. Eastern Standard Time. Both are going to last between 2.5 and 3 hours. And so this coming week on Monday and Tuesday, I'm going to be teaching a class on technical analysis and trading options. And I'm going to teach our community how to read charts the way that we read charts, how to read the momentum of the market, how to read a candlestick, how to read a trend, how to read a pattern, how to read support and resistance, and most importantly, how to put it all together to determine where to buy and where to sell something. And then on Tuesday, I'm going to be talking about trading options and utilizing the options market as your vehicle in applying those technical conversations. And we're going to have an amazing time. And we have a tremendous amount of people that are registered for this upcoming Master Trader course. It's something we typically do just in our pro membership. But in July, for our July 4th holiday sale season at Tackle Trading, which is ongoing through the Master Trader course. And so our holiday sales ends on the 15th. It ends on Monday at Tackle Trading. But if you're registered for that Master Trader course, we're gonna basically honor that holiday sales pricing through Master Trader if you are registered there. But we wanted to give this education to our YouTube community, to our Trading Justice community, to our Legacy community, to make sure that they have amazing quality of education. And obviously, if you love tackle trading and you want to stay with tackle trading after that event, you can obviously become a pro member of tackle trading and stay with us as you navigate after you do get the education. But Mark, education before application, that's the name of the game. And that's what we're going to do at Tackle Trading this week on Monday and Tuesday. And quite frankly, that's what we do at Tackle Trading better than anybody else out there. And I am extremely confident on that, because Tackle Trading is the #1 rated education company in the financial markets, 5 stars according to Trustpilot. Because Mark, we work with our students and our community, not over a day, not over a singular moment in time, but we work with them as long as it takes, period. End of sentence. And if you want to be with a like-minded education company like that, come over to Tackle Trading, become a pro member, sign up for Master Trader, and let's do this the right way, putting education in front of application. And that's what Tackle Trading does better than anybody else.
Yeah, listen, everyone, have a fantastic week. We'll catch you next weekend.
Later, team.